Do we have any questions from the audience?
To me, it's just a form of modern professional trading where you have very short holding times, where you're basically turning positions over frequently. Again, that's the frequent piece. You can, once you accept that there are computers involved and that you're turning positions over frequently, I think what exactly strategies are varies very dramatically. And it could be something that looks like a market making strategy. It could be something that's much more like short-term statistical arbitrage. It can be something that's more like spreading. It can, there's lots of different types of strategies that are all based around, using computers to make the execution more efficient and turning the positions over very quickly.
Yeah, I completely agree with that, and can't really add to it much except for the fact that I think it's important to remember that it's high frequency in relation to the market. So you might have some markets that trade a few times a day, and if you're one of those, that's fairly high frequency. And then you might have something like the E-minis that trade millions and millions of times a day, and if you only and you might trade once a minute, that might not necessarily really be that high frequency. So it depends on the what's in the market. I do think to your question, at least part of my point of being up here is not really to debunk the quotes, but to try to give a foundation, a better understanding that will help lead away from quotes like this. I think high frequency trading has become a catch-all phrase for I am confused about what's happening in the market. We hear about algorithmic trading. All trading is algorithmic. An algorithm is just a mode, a set of steps you take towards an end. It's a calculated process. So there's floor trading is algorithmic, and we hear about low latency trading when compare speed now to speed 10 years ago. Clicking on TT is low latency, and we hear all these different kind of phrases all lumped together as high frequency. And I think by trying to kind of explain some of these quotes and what's really happening as opposed to these quotes, at least what I'm hoping to get to is that we realize that high frequency trading isn't a catch-all phrase for electronic trading. It's a subset, and I think that subset is the rapid turning over of positions. It's made possible by speed that we didn't have a decade ago or 7 years ago, and so really you might be able to say if it's made possible by that speed, it's really just trading. High frequency trading is just using technology to hopefully buy low and sell high more than you sell low and buy high.
Yeah, I can't really add a lot to that, but one of the ways of thinking about it is that obviously every time that you do a trade, you hope that you have positive expected value. So if you're buying, you obviously think that the fair value of the market that you're buying is slightly higher than where you bought it. And if you're selling, then just the opposite. And so most of these strategies are just operating in a very, very compressed time frame to try to get little bits of edge around fair value. I think that's...
So Dean, let's say that there was a mutual fund in Kansas City and they needed to sell 70,000 E-mini contracts. If they did that in a low latency type of a way, would that be considered high frequency trading, or is that just low latency algorithmic execution?
Yeah, I think to the folks' points that they raised here, there's many situations where people are using low latency strategies that we don't consider high frequency trading, largely because the turnover that folks are talking about isn't there. People use low latency strategies to trade on news, right? The unemployment report's going to come out on the first Friday of the month, and there's people who have, very low latency systems set up to take that news and trade on that news and try and be the first one in the marketplace. So there are very, very many folks who are not high frequency traders who employ algorithmic trading strategies. Some of those are low latency, some of them aren't.
Okay. Any other questions from, yes, sir?
Yeah, that's sort of a different conceptualization that I have of really how it works. So there are rebates that on the equities markets in particular and other markets as well that are available to participants based on what the nature of their order. On many exchanges, and traditionally over the last 10 years, that's been for the poster of the order initially. They get a slight, 0.3 of a penny, 0.2 of a penny rebate on every share that they trade. In other markets, it's inverted, where actually the person who's crossing the spread and using an active order, that they are the ones who actually get the rebate. So it's all over the place. To me, that cost structure, whether it's a rebate or a cost, we just think about that as part of the spread and parts of the total cost of trading. And what we see is that across markets with different fee structures, those really equalize. So you can't really think about profitability absent the fees or the rebates. You really need to look at it all as a package.
Any other questions over here?
That's a good question. I'll start. We stayed in the markets until we couldn't. And what I mean by that is we have risk profiles set up on every trade. And those risk profiles have a lot to do with position we've taken on. It has a lot to do with moves within a certain amount of time. It has to do with how many orders you have on the market, maybe how many prices you've missed trying to get out of a position in a row. There's all a large variety of these kind of risk settings that will tell us, something is not as we would expect it to get out of the market. So we stayed in until those settings triggered, and then we got out. Now, when you do that, one of the first things you do is you make sure everything's working properly in your own software. And even though we saw the markets on the screen plummeting, we still, you follow protocol, make sure it's not your trades. And we did, and it wasn't, and that was good. And then we said, all right, now take a breath. And as any prudent trader would do, you get an idea of your surroundings before you go back in. And the surroundings did not look beneficial to trading. So at that point, we didn't necessarily get back in. Now, as it all started to slow down, we did get back in. And the markets actually continued to go down a little more, but we didn't hit our risk settings. And then it went back up, and we participated in it going back up. And by participate, I don't mean we bought a whole lot because we thought, man, this is cheap, and then we watched it ride back up. We continued our normal functioning. Our strategies operated as normal. There were market makers, there were spreaders, there was all sorts of strategies that operated. So I tend to think of it as, we did what we view as the prudent thing. We participated as long as our predetermined risk would allow. Then we got out of when that got us out, we decided not to go step in front of a freight train. And then as the market seemed to calm a little, we got back in. Some of those markets calming was benefit of CME, pausing the markets briefly. That was nice. That helped everybody kind of step back and take a breather. I'm actually interested to know what was going on with the CME at that time, so I'm hoping Dean responds as well.
I mean, we were in some markets we were, active throughout, and our systems functioned throughout. And others, we viewed the risk of busted trades because of the bust policies of some of the exchanges as outweighing the, the expected edge that we would capture. So in those markets, we stopped trading. One of the premises of your question was, you guys have taken a lot of blame for this, and actually, there was this joint SEC CFTC flash crash report, which didn't actually say that. Quite the contrary. Stepping back to one of my points earlier, I don't know if you recall, but that day there was a lot of uncertainty going on in the world, and there was some pretty crazy news coming out of Europe. So again, I mean, there were some fundamental drivers which caused greater uncertainty, greater risk aversion, and that generally tends to exacerbate volatility. I think that those are important takeaways because we're still in a very uncertain world. I expect that we'll see a lot of volatility going forward, but it's really a result of fundamentals.
Yeah, to what Don said, is actually, I wish I had a screenshot of this. If you had CNN on mute that day and you couldn't hear the stories, they often have the bottom, there's words that go to other stories as opposed to what the picture is. I actually had CNN in my office on mute and looked up at the screen, and there was a building on fire in Greece. It didn't say it was Greece, and people running by it and throwing things into the fire, and below it the caption said Dow dropping rapidly. You know, it's like, that's like an apocalyptic vision that was on TV at the time.
Yeah, I think, you know, sort of backing up to the general question of, you know, the flash crash and what was unique about it, what do we learn from it? I think we've now had an experience of a number of periods of great volatility in recent years that I think, you know, doing sort of a compare and contrast between the periods is pretty instructive as to what was going on. If you look at the fall of 2008, huge volatility, lots of days with 6, 7, 8, 9, 10% swings in the S&P 500. During that period, while you might not have always liked the prices that were on the screen, the markets opened on time. They performed continuously throughout the day with good liquidity and good price discovery. You look at the most recent period of August, you know, this last month, huge volatility, big swings on a daily basis. The markets performed pretty well. While you might not have always liked the prices, they were continuous. The markets functioned in their sort of fundamental way, and that sort of leaves the flash crash. And I've done a little bit of head scratching and trying to figure out what was different about May 6th of 2010 than these other periods where you clearly had high frequency traders, you had lots of automation, you had pretty much the same market structure rules. And I think there's a couple things to focus on, and this is really, you know, a lot of this comes out of the SEC CFTC joint report that Don was mentioning, which is that there were some significant technology malfunctions that were going on at primarily the equities exchanges, where you had slow data coming out of the exchanges that really exacerbated the fundamental uncertainty that was going on that day. So from any market participant standpoint, looking at the markets, there was a significant doubt about whether the prices that they were seeing on the screen from some of the markets were real prices that they could rely on. I think that was a key differentiator between May 6th and the other periods. In this most recent period, I think one of the great stories that needs to be told is how well the exchanges performed. You know, there were not these declarations of self-help. There were not significant slowdowns. Investments that the exchanges made over the last year or so really paid off in terms of giving that much more resilient technology. I think the other thing that needs to be focused on is the lack of circuit breakers that existed in the equities markets back in May of 2010. And this was really a weakness in the market structure, that there was not this period of time where traders could manage risk, could check technology performance, and could get back into the market in a real safe way. So people had to create those circuit breakers on their own by managing their own risk with their own rules in ways that were probably disjointed from each other. And I think this unification of these different circuit breakers and common sense safeguards in the last year and a half really helped a lot over the recent period.
So basically you're denying that you ringing the bell 3 days before the flash crash had anything to do with it at the NYSE,
Well,
right?
they haven't invited us back.
They haven't. Okay. Dean, do you want to close with any comments? Don was hoping you'd say something.
Yeah, I mean, look, I think the story of that day was that there was tremendous liquidity demand, right? And ultimately that demand outstripped the supply that was available. And I think that actually, but for the high frequency traders absorbing that demand on the way down, things would have been much worse. But for the risk controls in our market that we had, I mean, there were numerous orders that, you know, didn't have as much of an impact because they hit a protection point. Stop logic kicked in, paused the market for 5 seconds, and the market rallied afterwards. We didn't cancel any trades throughout that period. And in fact, during most of that hour between 1 and 2 o'clock that day, I mean, literally on a second-by-second basis, the market was generally a tick wide, right? It was thin, right, but it was orderly. So, I mean, I think that you're going to have situations where there are liquidity crises, right? And those are generally fundamental issues. And to Peter's point, right, I mean, the high-frequency traders took a lot of criticism saying that they pulled out of the market and that contributed to the flash crash. I mean, from a regulatory perspective, it would be irresponsible, right, for them to stay in the market with algorithms that weren't designed for those particular market conditions. I mean, we expect them to have appropriate risk controls in place. We expect them to be monitoring their algorithms. If their algorithms aren't designed for a particular situation, they should be out of the market. If they're doing an arbitrage between the E-mini and another equity exchange, and they can't rely on the quotes that are coming from one exchange or the other, I mean, their algorithm doesn't work. I mean, it would be irresponsible for them to stay in the market. So I think in those types of situations, we have to recognize that we are going to have liquidity crises, hopefully rare, right? But, you know, when you have smaller liquidity issues, transitory liquidity gaps, right, you can have those controls in place that help mitigate that kind of volatility.
So at the Grammys, when you hear the music starting to play, that means that your speech is over. So thank you very much for coming. Thank you very much to the panel. Thank you for the FIA IT Division for inviting us to participate, and we'll see you at cocktails.